Welcome to Financial Focus, brought to you by Gulf Coast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have provided North Florida savers and investors sound, comprehensive financial guidance for over 25 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting gulfcoastfinancial.net.
And welcome into the program. This is Financial Focus, brought to you by the best of the best in financial services, 6 years and running, as voted by the Lake City Reporter, the team from Gulf Coast Financial Services, your resource, ladies and gentlemen. Founder, CEO, John Kuykendall here, providing us with the guidance and the common sense approach to planning for our financial future on Financial Focus each and every week. John, welcome back in.
Thank you, Peter. It's always great to be here and talk about financial planning and talking about income planning. And I think our topic today, 401ks, is really going to be exciting and hopefully beneficial to a lot of our listeners out there.
Well, it is probably the most commonly used tool for saving for retirement. Now, it's got a lot of benefits, John, but there's also some drawbacks for every financial vehicle and option. I think there's pros and cons, and we really may need some better education about the utilization of the 401k or really any employer-sponsored plan, and then what some of those drawbacks are, so maybe we could work to avoid some of them.
Well, that's right, Peter. I mean, ever since 1983, when we came out with the regulation that taxed Social Security, but also made 401k plans available to the employers. This has been a great way to save money, but also there's a lot of unknowns about it, and there's a lot of miseducation. A lot of times the employee doesn't get enough education at the start of the plan to really make the decisions. And there's a lot of good to it, but there's also a lot of bad.
Yeah, I think the only advice I've ever gotten on my 401k is just make sure the lines add up to 100%. The company, the human resource director, they don't want to take on the liability of actually providing any guidance, and probably rightfully so. They don't know our situation good enough to provide recommendations, and they're not financial professionals.
That's true, and they're not going to take that responsibility or that liability. You can't expect them to. So what we recommend is that you seek financial advice outside of the plan to get someone to help you make a decision as to what kind of allocation you need, what kind of investment parameters you want to make, and then follow it and monitor it. I think, as we talk later in the show, one of the things we're going to talk about, or would have talked about, was the fact that a lot of people don't monitor these plans. It's kind of like a thing where if it's automatic, and a lot of companies now automatically sign you up, which I think is wonderful. But a lot of people take the approach that I just get the statement, I throw it in the drawer, and if I don't know what's happening, it can't be bad. It's got to be good. I remember back during the 2008 when we had the Great Depression, the recession, a guy told me, I said, "What are you doing in your 401?" He says, "I don't know. I haven't looked at a statement in 2 years." So, it's one of those things, out of sight, out of mind, but you make a lot of mistakes because your money's still in the market. Your money's still there working. Either it's negative or it's positive, depending upon what you do with it.
Well, again, so many pros and cons, so many details that we need to understand. Now, the first one, you mentioned it there, John, the fact that it's automatic, that it's out of sight, out of mind. We have a habit that if we bring money home, it gets spent and we don't do the savings that we should with it. So the fact that we can have that retirement savings to pay ourselves first done for us is a benefit. But at the same time, are people missing some of the education and the routine maintenance and the ongoing monitoring of the account because it's so out of sight, out of mind?
Well, I think that's right. And, a lot of times people don't want to sign up, but like you said, because it's automatic, that money's coming out of your paycheck every week or every 2 weeks or once a month. After a while, you forget that you're even doing it. And so the money goes in and you just totally forget about monitoring or watching it. And that's one of the main concerns. Another concern is, of course, every 401k has a match. The company's going to match a certain amount of your contribution in order to get you to be invested in the plan. Because one of the good things about 401ks is that they have to have the average employee sign up in order to get the benefit for the owners. So, or the senior management of the company. So senior management wants you to sign up. They want to give you a little bit of free money. But if you don't take advantage of that, if you've got a 4% match and you're putting only up 2%, then that 2% that you're not getting is free money that you're just giving away. Where can you make an investment and get 100% return on day one?
Yeah, I don't think there's any other place in the financial world, John, that you could say to somebody, you put $1 in and day one, immediately your account balance is $2. So probably don't want to miss the match. But there's a lot of people, John, who are contributing far more than the match. And perhaps that should be discussed because there may be a more advantageous order of operation or utilization of available opportunities.
Well, sure, Peter. And, one of the things I talked to a client this morning about her daughter who just got a 401k opportunity was because of their tax situation. They didn't need to be in a 401k. They needed to be in a 401k Roth. So the company had a Roth option. They would still give them the match, but they didn't get the tax advantages now, but they don't have to pay taxes on the gain. So the 401k Roth is a great way to go. And if you have extra money that you want to put up and you're happy with your 401k and the expenses, then go ahead and separate part of the money and do a Roth contribution.
So these are increasingly becoming more and more widely available, the opportunity for a Roth inside of the 401k. Perhaps if it's not, then we should pivot outside of the 401k and go to our Roth IRAs. But again, the order of operations matter when and how we use all of these available opportunities.
Oh yeah, Peter. And like I said, if you've contributed all you contribute to get the match and you have extra money, then certainly all that money we're deferring should go into a Roth either outside or within the plan, because it doesn't make any sense, as we keep saying over and over again every week, to pay taxes on the harvest when I have to pay taxes on the seed and the harvest. Why not just pay taxes on the seed or pay no taxes? So I'm paying the taxes now, but I don't have to pay the taxes later.
Well, I know that a lot of people are pretty worried about the direction that taxes may go into the future, rates, brackets. We sort of need to know where we are now. We need to have some understanding of the tax system to project where we might be in retirement. But a lot of people, John, have been taught to defer and delay paying taxes. We're rethinking that. We've talked about that in many of the recent past episodes. But it may be a situation where that Roth makes a little bit more sense these days than it did perhaps 10, 15 years ago.
Oh, I think that's true, Peter. I think one thing we've changed our whole way of thinking. It was, we said before, it used to be that we said defer, and then when you get into retirement, you're going to be in a cheaper tax bracket, a lower tax bracket, and you pull the money out, you'll be saving that much more. We know that's not going to happen now. Well, the way taxes are set up and the way that we have to pay for everything we do, and with inflation and all that's going on in the world, we know that when you retire, taxes aren't going to be cheaper. I can guarantee you they won't be, because I don't have a client that's told me that they really don't like paying taxes. They think it's a great idea that they're in retirement. They don't have to pay anymore. Everybody's going to pay their fair share. Why not do the Roth now, which is changing our whole way of thinking, and not have to pay those taxes? Now, somewhere down in the future, the government's going to change the Roth, the opportunity there, because they're going to see that more and more people are putting money into Roths, and so that legislation is going to change. But the government in the past has always grandfathered us. So if you're in a Roth, you should be able to stay in it until you retire and take the money out. You
already got that money in there, then it's there to stay. The government wouldn't mind you bringing it back out and putting it back in taxable circulation.
Sure.
But the laws that they change generally grandfather in people who had previously abided by the rules that existed at those times. And so that's what we expect here. However, the rules on the tax deferred balance, John, is that if they change the rules, those dollars are subject to those changes. So if taxes do go up, those with that tax deferred balance in those accounts are subject to those changes. So that's actually a little different there. And larger balance means a costlier mistake if we overlook that. So to defer or not to defer, that's a major question, a little bit on a case-by-case basis. And I know that you can help people understand the options and run an analysis of which is the best option for them.
Yeah, we can also take a look at their taxes and tell them what tax bracket they're in and help them make that decision. But certainly, if there's any way that we can put money up today and not have to pay taxes in the future, that's the way to go, because taxes are going to be higher. We're at the lowest tax point in our history of our country, and our debt has increased. I just read yesterday that the largest holder of debt is now not China, but Japan. Japan outpaced China with the amount of debt that they owe. So, everybody was worried about speaking Chinese. I think we're going to be speaking Japanese if we're not careful, because they own us. And we're going to have to pay for that debt. And as interest rates go up because of inflation, and interest rates eventually will have to go up, then we're going to be paying even more. Taxes have to go up in order to pay for all that. It's just a vicious cycle.
Well, again, there are options that we have in our personal financial lives that can help to better determine our outcome. John, you've said that as a planner, your job is to help your clients there at Gulf Coast Financial Services maximize the areas they have control over, minimize the areas that they don't have control over. We don't have control over the debt, not any of us individually, personally, or where that lies, but we do have the opportunity to control the tax exposure that we have if taxes are raised in the future. So something to keep in mind. And John, with those 401ks or employer-sponsored retirement plans, there are a few opportunities along the way to take that greater control. And I know there's a couple earmark events when those opportunities should be looked at.
Well, certainly if you've left your company and you have an old 401k, you shouldn't cash it out and take the money. That's the first option that most people want to do. We should roll that over into an IRA and then work on converting it into a Roth over time. But certainly that saves the taxes and it gives us a chance to invest the money and take control of it. The other one is when we reach 59 and a half, most plans will let us do what we call an in-service distribution. And so with that in-service distribution, I can roll the money out of the 401k, and then I have more investment options to manage it. But, the thing about it is, Peter, is, we need to take control. A lot of companies will allow you to borrow money from your plan, but I don't like that, because what happens is people say, I had a client, in fact, she was in here the other day, and I always kid with her because when the first time I met her, she had about half her 401k borrowed. And I asked her, I said, why are we doing this? And she said, well, I'm borrowing from myself. And so I'm paying myself back. And I said, yeah, but you're paying yourself back at 5%. And the market this year was 18. Which would you rather have? So, we are paying ourselves back and we're taking that money and using it, but we're not getting the opportunities of making money in the market like it should. And we have to pay that money back over 5 years. So it's certainly, or you're in trouble with the plan. So certainly that's something that a lot of people have advantage of, but we shouldn't do that. Shouldn't touch it. Only what we should do is manage it.
And in fact, John, you've got this great list of 50 401k mistakes. That's one of them. Don't borrow from the 401k. Yeah. I remember myself as a very young professional, one of my first jobs that offered a 401k. I left that job when I was about 21, maybe a little older than that, but I figured, hey, I'm leaving the job. Why not just withdraw the funds and use them for something? It was about $13,000 at the time. Paid the taxes, paid the penalties, and man, did I kick myself when it was time to pay those. Yeah. And then looking back on that today, kicking myself every time I think about it, because what could that have grown to today and the lost opportunity? How much further off did that perhaps put my retirement goals?
Well, sure. And that, that's one of the things, one of these 50 is cashing in. And a lot of people do that because they look at it like free money. This isn't free money. This is your money that you put up and the earnings it's made. It's your money. It's not like I just found a gold mine and all of a sudden I have this inheritance. It isn't. It's your money. And I know, Peter, I've done the same thing, small amount, They want you to get rid of it because they don't want to take care of it. So they'd rather give it to you. And so you pay the penalty and spend the money, and then you wish you had it set aside. One of the other things, and I think we've talked about a couple, but this is a great list of 50 things here. One of the other ones I like is not increasing your contributions. So, when we start out, we can't afford to put much in. And as we get pay raises, we can up our 401k, and we certainly need to do that to keep up with our salary increases. And then the one that I love the most is staying too safe. And I always think back to the client, and I've said this story before, Peter, when I met with him and I said, what are you doing with your 401? He said, oh, well, I'm in the capital preservation money market. Then I said, well, that's fine. How long have you been there? Oh, when the market went down, I went in. And I'm thinking 2008. And I said, well, it's a little long. Maybe we should have gotten back in the market. And he said, oh, no, I went in 2000. And this was 2019 when I was talking to him. So for 19 years, he made absolutely no money.
Wow. Except
his contributions. So we can be too safe with this as well as we can be too aggressive. And so we really need to look at our allocation, look at our risk factor. And I've always said, what's your sleep number? How much risk can you take and still sleep? And it has nothing to do with the bed. It has to do with your mind.
Why we need that professional guidance and perspective, John. I think a lot of us are maybe making missteps. Yes, it's a great tool. It's a great opportunity, but could we be missing further opportunity to be efficient with our money, to leverage our money, to grow it toward those retirement goals? And then I know there are several other topics here with the target date funds maybe not being the best, with the risks that are inherent. We've got to balance risk and safety, the limited options that are in 401ks and the fees and the contribution limits, all of those things. But the bottom line, John, the 401k is a tool. Your employer-sponsored plan is a tool. It is not a plan. And I think that's what we need to realize, is that somewhere along the lines in using this tool, we actually need to formulate the plan for how to utilize those dollars when we retire.
Oh, yeah, Peter. And, I always frustrates me when I talk to someone who's thinking about retiring. They have absolutely no plan in place. And the first thing they say is, well, I need $75,000 to remodel the house. And so I'm just going to pull that out. And I always ask them, I said, well, what is it going to do to your taxes? Well, I don't know. I don't care. It's my money. But, in retirement, as we've said before, it's not an easy situation. Everything you do in retirement triggers something else. And so that $75,000 can put you in a higher tax bracket. It can cause capital gains to be higher. It can cause your Medicare, your Part B. A lot of things depend on the tax situation. And when we do that income plan, we want to look at those taxes and prepare all of that. In fact, we're doing one tonight where we're showing the client wants to spend $70,000 remodeling a house. We're going to show them what's going to happen and what it's going to do to their plan and how we feel like we can give them a better approach.
Well, again, these are the type of recommendations, the type of guidance that you can get with a qualified, experienced professional advisor and the team of professionals there at Gulf Coast Financial Services. A lot of people will just walk through this stuff blindly, take a best guess at what the best financial option is for them. Get some professional recommendations, ladies and gentlemen. There's no cost for that. The guidance that they could provide could significantly improve your outcome, give you measurable benefits, and most importantly, that financial focus plan, the document that gives you a snapshot of where you are, a discussion of and documentation of those goals, write them down so you can work to achieve them, and then a timeline of executable action items that steps you can take in order to make those goals reality. It's not 1,000 pages of financial jargon. It's simple, concise, easy to understand language, easy to execute steps. And to get that financial focus plan, pick up the phone, give a call. Gulf Coast Financial Services, John Kuykendall and the team, 386-755-9018, 386-755-9018. You can always visit online, gulfcoastfinancial.net. If you are watching the video of the podcast program today, be sure to click those buttons to like, subscribe, share, ring the bell so you're notified of future episodes of the program. It's a mouthful to get all that in, John, but it's necessary. We need to remind folks that we are a constant resource for them, whether they just want some good information from afar or they want some hands-on advice and recommendations for their situation.
Oh, sure, Peter. And the way we've got the episodes labeled, they can go and look at a particular one based upon whatever they're looking for. But don't forget, they can also let us know, and we'll send them these 5401k mistakes free of charge. Just let us know that you want it.
Yeah, that's a great resource. Maybe peruse on your own time with your coworkers or with your spouse or your family. Make sure you're not making any of these mistakes, missteps, missing opportunities that could improve your financial outlook. It's an important tool, ladies and gentlemen, but we've got to use it correctly to get the outcome that we want. So get that list, the 5401k mistakes. It's another great offer and opportunity. And for that, we'll make sure to put a link in the description below the video. You can click on that and request the report. But John, always a pleasure. Fantastic information. One of the most important tools, and we appreciate your guidance on it.
Thank you, Peter. It was great to be here. Have a good week.
Always a pleasure every time we get the opportunity to visit with John Kuykendall here on Financial Focus. I know he's looking forward to hearing from you, helping any way he can. Give him a call, 386-755-9018, or take advantage of any of the resources that Gulf Coast Financial Services, Gulf Coast Tax Advantage have to offer.
Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting gulfcoastfinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through Gulf Coast Financial Services Inc., a registered investment advisor in Florida. Gulf Coast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.